Okay, now let's take a look at exercise 24-8, which uses the variances that we've calculated in the previous exercise, and we have those solutions in front of you. They gave us enough information about the BTS Corporation on the previous exercise that we were able to compute that the company had an $8,800 price variance, a $56,000 favorable quantity variance. This is for direct materials, or a material usage variance. And if we add those two together, we had a total of $64,800 of total materials variances. And that also was favorable. I'll put an F in there. Alright, well, normally the price variance gets recorded at the time you've learned of it. So we're going to assume that we purchased the 88,000 units in one purchase. So what typically would happen is we would debit raw materials, and with a standard cost system, this would be raw materials inventory, that debit would be equal to the 88,000 boards we purchased, and it would be whatever amount we've purchased. They haven't given us that in the problem, times the standard price, which is the $7 appearing right there, or $616,000. We would also have a credit to accounts payable, and that credit would be in the amount of whatever we paid for that price, and we know we purchased it at 88,000 board feet at an actual purchase price of $690. So what that tells us is we have to figure out where that variance falls. Now, it will be a credit if it's favorable, and if we've done this work right, those two equal 616,000, which they do, and we would simply record the direct materials price variance here. Okay, and I'll indent that so it's in proper form. Alright, that's how I would record it. Now let's record the material quantity variance or the material usage variance. The two terms mean the same thing. Now this one, that 56,000, gets recorded at the time we've learned of it. It occurs once we have some kind of record in our accounting system that says we reasonably can conclude that we know what that variance is. So it's primarily based on when production is going to be recorded for this particular manufacturing process. Okay? In this case, what we are going to do then is debit goods in process, also called work in process. I've seen it called both things. Inventory, right? Okay, now the goods in process represents whatever production says we completed, and it goes in its standard. So if we've completed this amount of work, the goods in process would get recorded at the 672,000. Okay, it gets recorded at standard. Let me scroll up so we can see that a little bit. You see I'm taking it from here. And then we would back off. Back off's the wrong word. We would move it from raw materials inventory, and the raw materials inventory would represent the full amount of actual that we had, the 616, meaning that we have another 56,000 of favorable variance to record, and this one is the direct materials quantity or usage variance. Okay, if we've done that one correctly, that would equal the 672. And that takes care of part 2, where we want to record the entries for these adjustments. Okay, The last part says to prepare the adjusting journal entry to close the variance account at the period end. Alright, the final entry we would do there is we would close the variance accounts since they're temporary accounts. And rather than type it, I'm going to copy it from here. So closing it means we know that we had an $8,800 credit balance in the direct materials price variance. We also had an amount in the direct materials. Oh, and one little mistake, I did not have this in proper form. Both of these would need to be indented. Okay, so then if I copy this over here, let's get those indented the correct way now. Alright, the price variance comes from that amount, right? Quantity variance comes from that amount, and they represent favorable variances. So with most accounting systems, that would simply be recorded as a credit to cost of goods sold to record the favorable variance on the face of the P&L, and we'll just sum that. Now, proper form also says that we would add some commentary. So this would be to record our raw materials price variance. Right? Let me do it this way. Slide that over. I'm going to just copy here and say this one is to record our, this time I'll use the word direct materials quantity variance. Okay? And then I'll copy this over so that the format is there, and this one would be to close favorable material variances to, and I'm just going to abbreviate it as cost of goods sold. Okay, part 3 says identify the variances that should be investigated according to management by exception, that's MBE concept. And the management by exception concept tells us that we need to look at sizable variances. Well, if we look at this as a percentage of the standard, this is $8,800 divided by a standard amount of 616, right? So let's take a look at that. We're talking about a 1.4% variance, so that's probably not worth investigating. If I copy that down here, we see that we have an 8.3% variance relating to that favorable usage. So it probably makes sense that we concentrate our efforts by understanding why we had a favorable usage variance. And that solves the problem.